This is an interesting debate because our economists have really tried to hold on to this view that, why is the Fed going to cut rates this year? They're not going to cut rates this year. And they've had to capitulate. And I think this is really about two things. One is the argument that there is concern rising in the labor market.
No question.
And so we see that as one of the key risks to this market. But I do think it's time to stop just assuming that we're going to look at the Taylor rule, we're going to look at the various kind of econometric models to decide when the Fed is going to cut, and recognize that there is a huge amount of realpolitik and pressure on the Fed to cut right now.
What do you think the cadence will be for this Federal Reserve, assuming they cut today 25 basis points? How do you think they go from there?
I think you get 2 cuts this year.
Okay.
I think as long as the current composition of the Fed is in play to the end of the year, they're going to want to try to position this as, insurance cuts, right? We think that rates are a bit restrictive. There's some concern about the labor market. We're going to say that inflation is driven as a one-off by tariffs, and therefore we can go slowly. The question is next year. I think the summary of economic projections today is actually going to be not that useful because you're going to have a very different Fed next year.
So as head of multi-asset for North America, how does that interest rate environment, how does the earnings environment, how does that shape kind of how you're looking at your portfolios these days?
The first thing it tells us is valuations are not the major concern for us in equity markets right now.
Wow.
It doesn't make you comfortable, but we don't think that's going to be the driver of risk here. Actually, as long as we continue to see these earnings upgrades in the U.S. market, we think the U.S. is going to continue. U.S. equities will continue to climb. We do have concerns increasingly about European equities. So earlier in the year, we were much more bullish on European equities. You've got this huge fiscal stimulus coming through in places like Germany, but we're not seeing the structural reform required to really unlock that market.
Because we did have in the beginning of the year when we had around Liberation Day and there was so much uncertainty, we had meaningful amounts of money move out of the U.S. and with the exception of the U.S. dollar, things seem to have come back.
That's right. I think people, when you actually look at the data, it seems like what overseas investors have been doing has been hedging their dollar position and keeping their underlying position, particularly in U.S. equities. And so the dollar has been that axis of weakness for that movement. And the reality is that when you look at what's happening in tech in the U.S., that has been where the earnings growth is occurring. Now, there's a very interesting movement underneath the surface, which is if I tell you that for the last 3 years, European value equities have outperformed the S&P 500.
Really?
So you have the U.S., this huge growth market.
Yep.
And even with that, the valuation mismatch that you had in European value equities.
But